Welcome to the deep dive. When you look at these financial reports, all the jargon, the complex tables,
Mm,
it's easy to miss that there are some really fascinating stories buried in there.
absolutely. They're like x-rays, really,
Yeah.
giving us a peek inside companies, seeing how they're actually doing, how they're navigating, well, everything that's going on.
Right. And that's our mission today. We've got a stack of recent reports, financial, operational, and we want to pull out the key insights for you, cut through the noise, connect the dots between the numbers and what's happening, on the ground.
Yeah, we've got quite a range. Insights from energy companies dealing with prices, the real costs and maybe upsides of big acquisitions,
hmm
and even what companies are worried about next. Things like AI, climate change. It's all in there.
Okay, let's dive in then. Let's unpack this. Maybe we should start with just a quick pulse check,
Huh.
looking at those basic numbers, revenue, income, profit, just to get a feel for how different sectors are stacking up right now.
Sounds good. And right off the bat, on the strong side, Technip FMCP cooled really caught my eye.
I know. Oh.
Yeah, a really significant jump in income before taxes and net income too, both for the quarter and the half year ending June 30th, 2025.
Wow.
And their gross profit for the 6 months also up notably. Subsea added, what was it, $209 million?
Hmm.
And Surface Technology is about $6 million year over year.
So pretty robust. Okay, so strength and energy services there. And they weren't the only ones doing well.
No, definitely not. Renaissance Here Holdings, the reinsurer, they showed a healthy increase in net income for their common shareholders.
How healthy?
Well, for the 6 months, it was nearly $1 billion, $987.7 million to be precise. And their net investment income got a nice boost too.
$1 billion. Okay, that's significant.
hmm And we also saw good news from Wabtec, Westinghouse Air Brake Technologies. They reported increased net income for both Q2 and the first half.
Right, the rail tech folks.
Exactly. And Comfort Systems USA in building services saw total revenue climb past $4 billion for the first 6 months. Both their mechanical and electrical segments grew quite a bit. Seems like demand is pretty solid there.
Okay, but here's one that really made me look twice. Newmont Corporation.
Ah, the mining giant. What did you see?
Their cash flow from operating activities, it jumped 103% in the first half of 2025.
Doubled. Wow.
Yeah, basically doubled. And net income from continuing operations shot up by $1.2 billion compared to the same time last year. Adjusted EBITDA was up 52%. That's a lot of cash being generated.
It really is. Speaks volumes about efficiency, maybe commodity prices helping too in that sector.
Right.
But like you hinted earlier, it wasn't all smooth sailing everywhere. We saw some growth stories that had, let's call them caveats.
Okay, like who?
Well, take Centene Corporation, healthcare space. Their commercial segment revenue was up 24%. Membership grew 33% in the first half. Pretty good, right?
Man.
But their gross margin actually decreased by $850 million.
Ouch. How come?
They mentioned a couple of things. A reduction in their 2025 marketplace risk adjustment transfer estimate.
Okay, that's the mechanism where plans sort of balance out payments based on how sick their members are, right?
Exactly. So less coming in from that. And also just increased medical costs. So more members, yes, but profitability per member took a hit.
Got it. So growth isn't always profitable growth. Did we see that elsewhere?
Kind of a similar thing with Waste Connections, Inc.
Yeah.
Revenue was up,
Okay.
but their EBITDA margin, a key profitability measure, it actually dipped slightly, both for the quarter and the half year.
And why was that?
They pointed to higher corporate overhead, risk management costs, labor costs going up, and maintenance expenses. The usual suspects squeezing margins.
Right. Inflationary pressures hitting even essential services.
Seems like it. And then there's Ovenative, the energy producer. They saw a pretty big drop in net earnings before tax for the first half, $206 million this year compared to almost $900 million last year.
Hold on, but didn't you say energy prices were up? I thought they mentioned higher natural gas revenue.
They did. That's the interesting part. Natural gas revenues were up by $313 million because average realized prices jumped almost 50%.
So higher prices, higher revenue,
Mhm.
but lower profit. How does that work?
It suggests other factors are at play, right? Maybe hedging losses, maybe higher production costs, maybe something else entirely impacting the bottom line despite the higher prices. It shows you can't just look at the commodity price.
Okay, so if we step back and look at this first batch, what's the big picture?
Well, it seems like we're seeing definite strength in certain areas, like energy services, mining.
Yeah.
But we're also seeing real cost pressures and some complex dynamics, especially in healthcare, maybe some service industries. It's definitely not a uniform economic picture out there. It's quite diverse.
Right. Different sectors, different stories. And it's clear these companies aren't just, passively reacting. They're actively trying to shape their own destiny.
Exactly. Which brings us neatly to the next bit, the strategic moves. Acquisitions, divestitures, how they're managing their capital. This is where companies are placing their bets for the future.
Yeah, this is where it gets really interesting. And on the M&A front, Aon Plaque was, wow, incredibly active.
They really were.
9 acquisitions in the first 6 months of 2025. 7 in risk capital, 2 in human capital.
And that's on top of that huge NFP deal they did in April 2024. Remember that, $9.1 billion, mostly stock.
That's right. A massive play. They're clearly trying to build scale and broaden their services.
Definitely looks that way.
Okay.
And Wabtec also made a big financial move. They set up a new $2 billion unsecured credit agreement back in April.
Okay.
Included a $725 million delayed draw term loan. They used part of that to refinance older debt, which is smart.
Sensible.
And then, after June 30th, they tapped the remaining $250 million from that loan specifically for an acquisition inspection technologies. So using debt strategically to fund growth.
Okay. Linking finance directly to M&A. And Ovintiv was also playing offense and defense, wasn't it?
Yeah, very much reshaping their portfolio. They boosted natural gas production significantly with the Montney acquisition in Q1, had about 173 million cubic feet per day.
The big boot.
But in the same quarter, they sold off their Uinta and Horn River assets. That cut production by about 42 million cubic feet per day. So it's addition and subtraction. Optimizing the portfolio, focusing on core assets.
Right. Shedding non-core stuff. We saw that with Cemex too, didn't we?
We did. A big divestiture there. They sold their operations in the Dominican Republic in January for $928 million.
And booked a big gain.
Yeah, a $583 million gain on the sale. That frees up a lot of capital, potentially reduces debt, lets them focus elsewhere. Classic strategic divestment.
And beyond buying and selling whole businesses, there was a lot of action in just managing capital, returning it to shareholders, dealing with debt.
Oh, absolutely. Newmont was a prime example of really active capital management.
We mentioned their cash flow earlier. What else were they doing?
Well, they sold off their Occiam and Porcupine segments, got over $1.5 billion for those combined. Divested parts of some other investments, too.
Okay, bringing cash in.
Exactly. Then they used cash to redeem almost $1.4 billion in senior notes, paying down debt. And they returned a lot to shareholders. Settled $1.36 billion in share repurchases under an existing program, and then got authorization for a new $3 billion repurchase program in July. That's a strong signal of confidence and focus on shareholder returns.
Definitely sending a message there. And
Yeah.
Technip FMC was also tidying up its balance sheet.
Yeah, they significantly cut their total debt down by almost $200 million. A big chunk of that was just paying off some private placement notes that matured.
Okay.
And they were buying back shares, too, about 8.3 million shares, at an average price just over $30, returning value that way as well.
And A.O. Smith, the water heater company, they tapped the debt markets too.
They did. Issued $500 million in 10-year notes back in February, privately placed.
And what was that for?
Mostly to pay down borrowings on their revolving credit line, general corporate stuff. They also used a commercial paper program to get another $60 million, so actively managing their funding mix.
So when you see all these moves, buying, selling, refinancing, buybacks, it really begs the question, right? How do these big strategic shifts actually position these companies? Does it make them more resilient, better set for growth?
That is the core question, isn't it? It's about setting the stage. But these grand strategies only work if the day-to-day operations are clicking.
True. You can have a great plan, but you need to execute. So maybe we should look closer now, beyond the headlines, at what these companies are actually doing day to day. What are the industry specifics, the hidden hurdles?
Yeah, let's get into the operational weeds a bit.
Yeah.
For Technip FMC, we mentioned their strength. They seem to have really strong visibility on offshore projects looking out towards the end of the decade.
So a good pipeline.
Looks like it. And interestingly, their surface technologies segment is heavily reliant on international markets, North Sea, Asia-Pacific, Middle East. That was over 60% of the revenue last year.
And the U.S.?
They actually expect U.S. land activity to be a pretty small piece for them this year, like only 5% of total company revenue. So very much an international focus there.
Okay. What about Ovintiv? We talked about their portfolio changes, but how were things operationally?
They hit some snags, mentioned lower regional prices impacting their U.S. operations. And in Montney, where they made that big acquisition, they had some production volume cuts because of pipeline restrictions
Yeah.
and more downtime than expected at third-party processing plants.
Infrastructure bottlenecks, always a risk in energy.
Yep. It shows that having the resources is one thing, getting it to market efficiently is another.
And Eni, the Italian major.
A bit of a mixed picture there. Overall production was down slightly, about 3% in Q2, partly portfolio changes, partly just mature fields declining, which happens.
In short decline.
Right. But they offset a lot of that with new production ramping up from projects all over the place. Côte d'Ivoire, Congo, Mexico, Italy, Indonesia, Norway, Australia.
Wow, really global.
Very dynamic, very geographically spread out operationally.
Okay, let's switch to healthcare and insurance. Centene flagged a potential issue, right? Something about tax credits.
Yeah, the enhanced APTCs, the advanced premium tax credits that help people afford marketplace health insurance. The current rules expire at the end of 2025.
And if Congress doesn't extend them?
Centene said it could materially and adversely affect their marketplace membership. That's pretty direct language. Plus, some other rule changes coming in 2026 under OBBA legislation could also impact eligibility. Regulatory risk is huge in healthcare.
Definitely. And for Renaissanceur, the reinsurer, real-world events hit hard.
They did. The 2025 California wildfires added almost 16 percentage points to their loss ratio for the first half of the year, a direct hit from a major climate event.
That's substantial.
It is. But on the flip side, they also reported nearly $200 million in favorable development on past catastrophe claims, mostly from weather events between 2021 and 2023.
So past claims sometimes end up costing less than initially thought.
Exactly. It shows how long the tail can be on these things and how estimates change over time. Risk is complex.
And Hanover Insurance also had some surprises from the past.
Yeah, they noted some adverse development, meaning claims cost more than expected in their construction liability business, but from accident years way back, 2016 to 2019.
Why so long ago?
They specifically cited inflation uncertainty around construction defect issues. So even years later, rising costs can make old claims more expensive.
Huh. Interesting. Okay, mining, Newmont. We know cash flow is great, but any operational challenges?
Yes, at their Cadia mine in Australia, gold production was actually down 11%.
Why was that?
Primarily because the ore they were milling was lower grade, less gold per ton of rock.
Makes sense.
And that, combined with higher energy costs and royalties, meant their cost per ounce of gold produced jumped 29%.
Okay, so efficiency challenges there.
And on top of that, they're facing legal action at Cadia over alleged air pollution. There's a hearing scheduled for early 2026. So operational issues can be geological, economic, and legal or regulatory.
A complex mix. And finally, building services, comfort systems.
They highlighted just how tricky it is to estimate revenue and costs on their long-term contracts. You've got variables, change orders, performance milestones. It's not straightforward accounting.
I can imagine.
What stood out, though, was that their technology customer segment is now their biggest, over 40% of revenue in the first half. And it grew significantly. Shows where a lot of the construction demand is coming from. Data centers, tech facilities, that sort of thing.
Right. So looking across these operational details, it's pretty fascinating, isn't it? How things like, wildfires or pipeline capacity or even ore grades directly impact the bottom line.
It really is. It shows that interplay between the big picture strategy and the nitty-gritty of actually getting things done day to day. It's a constant dance.
Okay, so we've looked at performance, strategy, operations, but what about the future? What are these companies looking ahead to? What risks are they flagging? This is where we look beyond the current balance sheet.
Right. And some interesting themes emerge here. Technology and data risks are definitely top of mind for some. Cemex, for instance, explicitly mentioned concerns about how data protection laws are evolving globally.
Data privacy, GDPR, things like that.
Exactly. And they went further, flagging potential issues with AI, biometrics, privacy tools leading to things like bias, miscalculations, data errors, and intellectual property infringement.
Wow, getting specific about AI risks.
Yeah. And they also connected the dots between remote work, online shopping trends, and the potential impact on construction demand for offices and retail spaces, their core market.
That's foresight. And they mentioned climate change, too.
Explicitly. Listed things like excessive rain and snow, shortage of usable water, wildfires and natural disasters as potential risks to their facilities, their markets, even their raw material sources. Very direct about the physical risks.
So connecting AI risks and climate risks directly to their business, that's sobering.
It is. Then you have the more traditional market and economic risks. Wabtec, for example, said their overall market risk exposure hadn't changed much, but they actively use hedging programs to manage foreign currency volatility.
Standard practice for multinationals, but important.
Crucial. And Gayron showed stability by staying compliant with all the financial covenants on their big credit facilities. They also got final court approval in July for a settlement in that big antitrust case involving interest rate swaps. Clearing legal hurdles is important for outlook.
Good point. Did any companies give specific forward-looking targets?
A.O. Smith did. They gave pretty clear guidance for 2025, expecting cash from operations between $600 and $625 million and free cash flow between $500 and $525 million.
Setting expectations.
Exactly. Helps investors understand where they think they're headed.
And underpinning all of this reporting, several companies, you mentioned A.O. Smith, Waptec, they made a point of confirming their disclosure controls were effective.
Yes, as of June 30th. That's sort of a standard statement, but it's important. It's management signing off saying, "We believe our reporting processes are solid and the information is reliable." Gives investors confidence.
Absolutely vital. So if you tie all this future-looking stuff together, what's the overarching theme?
I think it's clear that companies aren't just dealing with the usual financial risks anymore. They're actively grappling with this new wave, rapid tech change like AI, the very real impacts of climate change, shifts in how people work and live.
Right.
It's forcing them to adapt, to innovate probably faster than ever. And the fact that they're being more transparent about these risks, well, that gives us a valuable window into what the future of business might actually look like.
Wow. Yeah, what a journey through just a handful of reports. We went from Technip FMC's offshore prospects,
Newmont's big divestiture,
Centene wrestling with healthcare policy.
Sandvik's thinking about AI and water shortages.
It really shows how many different forces are shaping these companies.
It really does. This deep dive, I think, shows that every balance sheet, every income statement, it's telling a story. Not just about numbers, but about, human decisions, huge market forces, these global challenges that connect everyone.
So maybe the thought to leave everyone with is, as you go about your day, see news headlines, look at company results, think about the stories behind those numbers. How might these little details hint at the bigger economic tides? What other aha moments are just waiting to be uncovered in the data all around us?
Good question to ponder.
Thanks for joining us for this deep dive.